Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get back to the trade story, which remains front and center here. It seems like we're in a period where negotiations are happening between the Trump administration and a number of different countries over a number of different tariff measures here. So it's important to try to stay on top of kind of where we are, and we have a good team doing that. Brendan Murray joins us, Global Trade Editor for Bloomberg News. He's in London. Brendan, it seems like the president over the next several weeks, is it fair to expect that we'll get some announcements on trade deals with some of our major trading partners?
Yeah, well, it depends on what you mean by a deal. It's fair to say that we're likely to get a number of announcements laying out the path for talks for an eventual deal. Trade deals are very complicated. They take a long time to hammer out. And to get anything meaningful, it's going to take a lot of time. But what you could see are some sort of interim proposals, interim agreements that would set the U.S. and the trading partner on that course. Some of those who are sort of have an early lead would be India, South Korea, Japan. These are big export economies that the U.S. wants to trade more with, to reduce the tariff and non-tariff barriers that they have with the U.S. economy. So we could see some action along those lines, but again, to expect anything major, anything fundamentally changing the picture of the U.S. trade imbalances like Donald Trump would like to see is probably a bit of wishful thinking.
Now, Brendan, you said Treasury Secretary Scott Bessent said the administration working on a bilateral trade deal with 17 key partners, but not including China. So where does China stand in all this?
Yeah, well, this is the big, that's the big prize, right? Is some sort of deal with China, and if the U.S. and China aren't even talking, and by all accounts, according to they're not really having any sort of formal discussions that would lead in the right direction toward a formal sit-down discussion, that you're leaving out a big part of the imbalance, the biggest imbalance that the U.S. has. So you can talk trade deals with Japan and South Korea and India and other countries, but the real prize is that Donald Trump wants is a trade deal with China, and so far they're going nowhere on that.
David Rosenberg, a frequent guest on Bloomberg Surveillance, formerly of Merrill Lynch, he's a Canadian, and out with a tweet saying basically, hey everybody, I know you're focused on China, but you need to figure out something with Canada, because Canada is the big trading partner with the U.S., as is Mexico. Where do we stand, do you think, with Canada and Mexico?
Yeah, well, the Canadians don't sound like they're in the middle of an election right now, and they don't sound like they're in any big hurry to do a deal. The Prime Minister Mark Carney said the other day, we'd rather have a good deal rather than a fast deal. So we'll see how that election plays out. That could dictate the course of any negotiations. But in the meantime, the Canadian economy is going to suffer. American auto companies are going to suffer because they rely so much on Canadian suppliers. So you could look for a lot more disruption the longer that drags out, with the cloud of uncertainty hanging over it as it has for several weeks.
And Brendan, what about the big companies, let's say Walmarts and Targets, the retailers? They have to replenish their inventories. Where do they stand in all this?
Yeah, so this is a big story we have out today, is that retailers like Walmart and Target, the big ones and small companies, are looking at those 145% tariffs on goods from China and saying, we can't do that. We can't afford that. That's more than twice what we could pay. So we're just canceling orders from China. And so what we're seeing is, in a couple of weeks, when those orders would have already gotten here, we're going to see volumes through U.S. ports go down. We're going to see inventories through warehouses go down. And the big retailers have even said privately to President Trump, according to our reporting, that this could mean shortages and price hikes. So the wave of decoupling that is underway between China and the U.S. hasn't really hit the real economy right now. We hear the administration say, oh, well, Wall Street has had a good run. It's time for us to focus on Main Street. Well, Main Street is about ready to get hit with some of this, and unless things change fast, then we're going to start seeing it in a lot of in some layoffs in industries like trucking and logistics and warehousing, where really the rubber meets the road between trade and the U.S. economy.
Are we past the point of no return, Brendan, in terms of some of the economic damage that could be done, in terms of supply chain not getting the stuff that we typically get?
Well, in the short run, if President Trump announced later today, which nobody would expect this, that he was freezing all tariffs, and he was gonna try to do this another way. If he kind of backpedaled on everything, we'd still have a supply whiplash. All those canceled orders would be placed again, and we would have the volumes surging through U.S. ports. And we saw during the pandemic what happens when the nodes of supply chains get bogged down. Is we had 120 ships parked outside the port of Long Beach and Los Angeles. So that's the kind of thing. Most people don't think it's going to happen on that kind of scale, but the system can't handle big declines or surges in volumes, and that's what we're looking at over the next several weeks or a few months.
All right, Brendan, thank you so much for joining us. Always appreciate getting your reporting. That's Brendan Murray, Global Trade Editor for Bloomberg News, joining us from London. And again, there's some reporting out of Bloomberg and others over the weekend, just simply the volume of ships leaving Chinese ports setting sail for presumably the west coast of the U.S. And we often talk to Gene Soroka, who runs the port of Los Angeles and Long Beach. And we'll search to get back in touch with him in the next couple of days. But some of those sailings have declined dramatically just in the last couple of weeks. So perhaps that's reflecting what Brendan was suggesting was maybe some canceled orders from some U.S. wholesalers and retailers. We'll stay on top of that story.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, big earnings week out there for the S&P 500. We have $20 trillion in market cap. It's going to report earnings this week. That is big. We had about $11 billion last week. And some of the big companies that are reporting are the technology companies, and you really want to get a handle on kind of how they're viewing the world these days. So we asked a couple of the smart folks that we know to join us here. Anurag Rana, Mandeep Singh, they are senior technology analysts for Bloomberg Intelligence. Anurag joins us from Chicago, and Mandeep is in our Bloomberg Interactive Broker studio. Mandeep, let me start with you here. I mean, just given what you've heard so far from some of the big tech companies and what you expect this week, how are some of the companies, these big technology companies, which have been real drivers for the stock market, how are they kind of saying they're seeing the world out there these days?
Yeah, I think in the case of Meta, I mean, clearly they are exposed to the de minimis rule, where companies in China can't really ship any products below $800 anymore. And that was a big driver of ad spending from Temu and Shein and some of these advertisers. So that's going to impact Meta. We saw in the case of Alphabet, the click ads grew only 2%. The pricing was relatively stable. So I think in the case of Meta, the ad pricing may come under more pressure compared to an Alphabet. And the ad impressions may be better than Alphabet. So because of the FTC case against Meta, and similarly for Alphabet, these companies have regulatory pressures as well. But there is no doubt that the macro environment has changed for the worse. And I don't see, even though the impact would show up more in 2Q, I don't see how they guide better than they did in the fourth quarter.
What about AI spend? How much of an impact is that going to have? Are the investors going to be looking to that?
Oh, so Meta raised their capex the last time they reported to $65 billion. And in between, there was news that Meta is looking for an Amazon and Microsoft to share some of that capex because they have an open source model. So I think they're under pressure to kind of cut back on the capex or the Reality Labs spend. But so far, no one has pulled back on AI capex, given we are still in a supply constrained environment when it comes to the GPUs and overall AI infrastructure. So it'll be interesting to see what they end up doing.
Hey, Anurag, I kind of think of even within technology, which is such a great growth story and can batter some slowdowns, I think of the software companies that you cover as kind of maybe one of the safer places to be within technology. What do you expect to hear from the Microsofts of the world?
Yeah, so Paul, on a relative basis, I think you're right about that. But at the same time, they do have an impact on the second degree demand. If the enterprise tech spending starts to cut down, that has an impact on software space as well. So that's something we will be looking for. But I would agree with Mandeep that we are not anticipating a drop in CapEx either from Microsoft or AWS later this week, because those are the names that dictate a lot in terms of how AI spend will shape up over the next 12 months.
Where within the tech stack, Anurag, do you think you could see maybe some of the biggest exposure to, I guess, just tariffs and maybe a slowing global economy?
Yeah, so Apple's going to be, front and center over there. There's so much news about, their ability to move the supply chain. That's not that easy. We do anticipate some pull forward in demand for them. We know Apple stores were really crowded before the tariff date, and that will show up in some of the numbers. But the question is going to be what kind of guidance can they give? And in fact, if they can even give guidance at this point, and how if there is a big number that goes up on tariffs, can they even fulfill the demand? So there's going to be a lot of noise around that supply chain and what they're doing to offset that both in the near term and in the long term.
And the other big story for today, IBM planning to invest $150 billion in the U.S. over the next 5 years. Mandeep, can you break it down for us? What does that include? That's a pretty big number.
Yeah, I mean, look, in the case of IBM, they are not a big spender on AI CapEx. So clearly, they are looking to expand in terms of their own investments, whether it's mainframe related or any other type of R&D around quantum. But we've heard that from Apple, $500 billion over the next 4 years. So right. A lot of these tech companies are looking to appease the administration, which is keen to, bring manufacturing back. It'll be interesting to see where IBM sort of thinks about investing the $150 billion, because as I said, they're not a big player when it comes to the AI infrastructure play that the other hyperscalers are involved in.
Hey, Anurag, I seem to remember a lot of the CEOs that you and Mandeep cover making their way to Washington, D.C. over the last 3-4 months, having meetings with the president and members of administration. Is there a sense that they're getting the benefit of that, or is that having any impact? Because I'm not sure I see that.
Well, one could argue that the smartphone exemptions that we got or the consumer electronics may have had something to do with it, but we'll find out if that can continue or not. But, frankly speaking, these companies are the ones that are really putting U.S. at the forefront. Will be very surprised if we see a much more hostile behavior against them. The big question is, as Mandeep mentioned, there are a few antitrust cases going across them right now for a bunch of these companies. We'll find out how the administration takes over or puts their credibility or the backing behind those deals.
Now, Mandeep, you mentioned before quantum computing when we were talking about IBM. I mean, are we going to be hearing more and more of that come in the future? Because we've been hearing so much about AI, but is quantum kind of going to move forward?
I think at this point, given the macro environment we are in, I would focus more on what the companies think is, monetizable in the near term. Quantum would be further out. At the same time, I mean, could 1 to 2% of those CapEx dollars go into quantum? Yes, but the big chunk would still be allocated towards AI and, specifically inferencing, because everyone seems to be quite bullish about the type of use cases that are emerging around AI agents and what it means for the overall enterprises.
All right, fellas, thank you so much for joining us. Always appreciate getting you guys, particularly when we get you guys together. Anurag Rana, Mandeep Singh, they're the two folks that kind of run our global technology research effort at Bloomberg Intelligence. And like you have to do, technology is a global business. Therefore, you need to have expertise on the ground all around the world, and we do. Asia, Europe, North America, we've got it covered for you. And Mandeep and Anurag run that business for us. We appreciate getting a couple of minutes of their time. It's going to be a big week for earnings. Continued big week for technology companies. To what extent is their business being impacted by some of the economic uncertainty that may be building out there as a result of maybe some uncertain tariff policy issues? So we'll see how that plays out this week when you get more, again, $20 trillion in market cap, those companies reporting this week.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
And we've got a lot of economic data, and maybe the question is, when are we going to start seeing some of the uncertainty in some of the economic data, whether it's GDP or inflation and that kind of thing. So we got to pay attention to that. So if you're a professional money manager, there's plenty to keep you busy. Kim Forrest, founder and chief investment officer at Bokeh Capital Partners, joins us here. Kim, kind of with that setup, what do you think is driving stocks here? Do we earnings or some of this bigger, I guess, economic data issues, or is it just what comes out of the Twitter account or X account or, of a certain president?
I think all of the above, but here's what I've learned from doing this for the past, I can't believe it, 26 years of looking at markets, is in a given day, they can really only process one or two ideas. I kid you not. If you go back to what happened on Friday, you can suss out what drove the market. And you look at the stocks and you look at the data that comes out and you go, aha, this is what drove the market. So I'm going to make a bold prediction that the thing that drove the markets last year clearly was NVIDIA and the AI trade. And this week, we're going to get a little bit more information on whether or not the AI trade is dead. And I think the answer is no, because we got a sneak peek from what happened on Thursday. I think it was Thursday. Every day seems like a lifetime. Anyhow, with Google. And Google reiterated that they are going to continue spending on their AI build out. And so we expect Microsoft, Meta, and Amazon to all say the same thing.
It's actually a very good point. And Kim, I've been asking the question all morning, are we going to see more cost cuts? Because there was a story in the Wall Street Journal that said corporate CEOs are saying the market version of the Serenity Prayer right now. Costs are the only thing that they can really control. And in the face of total uncertainty, that's the lever they're pulling. But I was talking with Gargi Chowdhury of BlackRock this morning, and she said, well, you know what? Google didn't cut its CapEx. So maybe we won't see a cut in CapEx from the other hyperscalers. And that's really what's driving this market, is that AI trade that we obviously saw so big last year. What about other companies, though, Kim? Are you worried that we're going to start seeing, especially smaller companies, start to fire employees, start to, close down stores, start to reduce costs wherever they can?
So the answer is always yes, right? For the troubled. Like Macy's is going to close a store in this, I don't know how big, it was a huge, huge mall, and there's only 3 things in it now. Maybe 4 if you consider the collectibles shop that's in there as well.
That doesn't count as a real business. That's like somebody's hobby.
No, it really doesn't, but I'm painting this, right?
Yeah.
Joanne Fabrics pulled the plug there, but we've got Macy's that is now going to pull the plug. Dick's Sporting Goods is going to pull the plug, but the Township of Fraser has its township building in that building, but it's massive. It is the hugest, most empty building I've ever seen in my entire life. But that is what we get, is companies that aren't succeeding are going to reshuffle the decks. Now, Dick's is doing pretty well, but in that mall, nobody's going to the mall. They're going to move somewhere else. No kidding. So that goes on all the time. But I would even say smaller companies that are successful are not going to just indiscriminately hire. What companies do have right now is technology that tells them what the pipeline is doing in real time. Most, even small companies, have a CRM system where they can see what demand looks like. And I think that is going to drive things, not tweets, not headlines. It's going to be what's happening with our business. And if your business is sick, you're going to make some cuts.
Kim, I mean, looking at the S&P, I made the comment earlier that depends on kind of if you're a glass half empty or half full kind of person. The bad news is that the S&P is down 10% roughly from its peak earlier this year. The good news is that it's up 10% from the bottom. How do you view kind of what's going on out there in the stock market generally?
Well, again, I'm kind of a mathematician. That's my basic training was that's what I graduated with, a degree in that and computer science. So I like to take apart the pieces of the S&P. And if I look at what was driving the S&P last year, and pretty much through the end of the year, was the AI trade. So that's the big Mag 7. I was going to call them the big 7. Mag 7, and then, especially NVIDIA. Now, NVIDIA's come down a lot, right?
21%
like
year to date.
Yeah. So that is overweight in the S&P, or it was really overweight in the S&P 500 calculation. So you have to look at that. And if you look at the rest of the S&P 500, they're really not going all that up or down, right? That most of that dip down and dip back up was the Magnificent Seven. And that was the blessing last year, and it's the curse this year. So you index buyers are just going to have to put up with that.
It's actually, at one point, it was down 37% peak to trough.
Yep.
With the peak being like the very beginning of January and the trough being 2 weeks ago. We've had a pretty powerful rally, though, over the past 4 days. Today, it's not looking like it's going to continue, but we had the swag breadth thrust indicator triggered. For at least the 18th, I've seen 3 different estimates of how many times it's been triggered since 1943, but it's been at least 18 times. And each of those 18 times, Kim, it's resulted in double-digit gains, on average like 15% 6 months out and 25% 12 months out. Do you put any trust into the swag breadth thrust indicator, which basically just says NYSE stocks, only, I think, 40% of them were at new highs, and then within 10 days, 61.5% of them were at new highs.
Totally clear.
Yeah.
So I'm going to use one of my favorite phrases that I think irritate people. That's interesting, but irrelevant. Because the truth is, a lot, and remember, I'm a math person. I used to be an AI person, which is math. I love math, but it tells me what happened in the past, not what's going to happen in the future. And there's so much that can happen in the future, like tariff deals signed, not signed, wars, not wars, just everyday life that doesn't necessarily let you, with assurance, know what's going to happen to your stocks in the future. So I'm cheered by this. If that happens, go whatever indicator. But I'm not going to, run my money based on it.
I was excited last week about it's the swag. Martin Swag invented this. The swag breadth thrust indicator.
Oh.
All right, put that out on social media. I'm sure that'll get a lot of hits. Kim Forrest, thank you so much for joining us. Kim is founder and chief investment officer of Bokeh Capital Partners.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.